we've been used to sort of this quite flat world. Same thing as applied to supply chain. And this has meant that as a supply chain manager, you have been allowed to, or you've been able to optimize your supply chain on one parameter, namely cost, right? So we started moving stuff to China. When then, coastal China became too expensive, we moved inland China. Then people started talking about China plus one. Then we looked at Vietnam, Cambodia, Laos, Myanmar, Thailand, whatever, what have you, right? And I think sort of what you mentioned, COVID, right? But then you suddenly got, a vessel blocking the Suez Canal. Then you got, the war in the Ukraine. Then you got, the situation with the Houthis, which means suddenly we have to sort of, go south of Africa. Then the U.S. West Coast, the longshoremen, they go on strike, blocking the ports. You got trade wars, all of these things. So I think the point really is that as Christy is saying, is we are not sort of, let's say, trying to pinpoint the next black swan event, but really what we're doing is we are trying to invest into companies that helps prepare or help sort of, create that readiness so you can replan and you can act around your supply chains, right?
Here's a few words from our beloved sponsor. Join over 500 LPs and GPs at 0100 Europe in Amsterdam from April the 2nd to the 4th.
You better be there too.
Connect with top-tier investors and industry leaders at 0100 Europe Amsterdam. Engage in exclusive conversations with decision makers from Bicycle Capital, Global Ventures, Dawn Capital, and many more. There you'll find over 80% of attendees are LPs and GPs, and you'll also find exclusive side events. 0100 conferences. Register now and use the code 15EUVC for a discount.
This was their finest tower.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome, everyone, back to the European VC podcast. Today, I have with me Sune and Christy from Nine Realms. Sune and Christy are both general partners at Nine Realms, which is a new fund being raised currently. It is they are targeting 200 million euros. They're headquartered in Denmark. Sune, you'll notice, will have about the same accent as mine, so terrible for you. Sorry about that. Target stage is Series A, and the geo is Europe and North America. Supply chain and sustainability is the focus, and they have invested in some beautiful prior investments, which is as a fund, clearly, and Forto, Loadsmart, A-Fresh, Altana, Platform Science, and Offload. That was a bunch of stats and a really quick overview. Either of you, please tell me, did I get something correct there?
Well, I think you got a lot of things. You got a lot of things right, and thanks for having us, Andreas. Yeah, I mean, as you're saying, we invest at the intersection of supply chain and sustainability, and we sort of come together as a team to sort of build this vision. We kind of been working towards the same goal from different vantage points for a number of years, and now we come together and we are building Nine Realms.
Tell me, because I only just briefly said the highlights, right? If we were to say a bit about yourself, also the team, how big is the team? Where do you come from? That type of thing.
Yeah, absolutely. Christy, do you want to introduce yourself, and then maybe I'll do the honors on behalf of the rest of the team and audiences.
Yeah, absolutely. So as soon as we'll get into, we've kind of built this team all coming from different angles of supply chain and investing. So my personal background, different accent to Sune and Andreas. I am Canadian, but based in London. I've been in London for about 10 years. Worked in finance my entire career. So starting out on the advisory side, doing transaction services and due diligence, and then moving into the investing side. So initially a focus on growth equity investing in Europe. Did that for a couple of years before moving into more early stage venture. So I joined a venture fund focusing on everything from Series A to pre-IPO investing and across a range of sectors. So actually a lot of focus on consumer internet at the beginning of my investing career. From consumer internet, we started focusing more on enabling technologies. So that was obviously within the supply chain and logistics, was seeing the huge opportunity there. And then also worked with a family office, which was exclusively focused on supply chain, specifically transportation investments within North America. So saw the huge opportunity, heard about kind of what Sune planned to build with Nine Realms, which we'll get into. So was really excited to really narrow in on this sector.
Yeah, and I'm Sune, the other guy with the Danish accent. I had an early career in tech back in the mid-90s. And then I joined Maersk, that will be familiar at least to the Danes, one of the world's leading transportation and logistics companies. I joined Maersk in 99, ended up spending more than 20 years with the company, which was certainly not the plan coming in, but I was fortunate enough to have a lot of opportunities. With Maersk, I worked both on the transportation and logistics side and on the energy side of the business. I filled a number of leadership positions all over the world, everywhere from Southeast Asia, Latin America, Europe, the Middle East. The last 3 businesses I was the CEO of was with an M&A sell side mandate. So I'd come into an asset that was partially or fully owned by Maersk, restructure that asset, sell it off, move on to the next one. The last of the businesses I sold was the largest oil field services provider in the Middle East. And while I was busy selling this business, Maersk in mid-16 introduced what became known as the integrator vision. So essentially sort of this concept of this strategy of becoming an end-to-end logistic provider, a one-stop shop, if you will. And as part of that, a lot of things happened, including I became what was called head of growth. So a role where I reported directly to the enterprise CEO for Maersk, became responsible for building the future of Maersk. So building the future revenue streams and kind of redefining the global transport and logistics industry. So moved back to Denmark in late 16 and started on that journey. We did a lot of things with that mandate, things around innovation. We built some businesses from the ground up, both more traditional brick and mortar BDV, like, cold chain logistics, less than container load. We were involved in things like building autonomous tugboats, alternative fuels. We built what became known as TradeLens later on, which was an aim at digitizing global trade documents on a blockchain. Most importantly, for what Christy and I and the rest of the team are doing today, towards the end of 17, I went to the board of Maersk. I pitched a corporate venture fund, which became known as Maersk Growth. Maersk Growth was one of the early, and I would argue most successful investors in supply chain VC on a global scale. So, during my time, we, backed, 20 odd companies and other than, of course, the financial returns, there's also been some very solid strategic returns to Maersk. Fast forwarding, we had so much success with this strategy that I started pitching fund 2 of that strategy, which to me sort of included a more LP agnostic platform. A lot of benefits, of course, as people will know, to having a single LP, also certain drawbacks. And I just couldn't sell that vision internally of a more LP agnostic platform, a multi-LP platform. So essentially went out and decided to build 9 Realms, which for all intents and purposes is the continuation of what we built at Maersk Growth. And we can talk a bit more about exactly what that is in just a second. But, we are currently 5 people in the core team, other than Christy and myself. So we are 2 people in Copenhagen, which includes another Canadian, as he's Danish-Canadian, and Marie, who's our latest joiner, comes with a lot of experience sort of within venture investment and also from a legal perspective, having ran a couple of funds in Canada for BDC, which is the largest Canadian venture investor. We also actually have a Danish-American on the team who spent his career within Morgan Stanley, doing investment banking, technology banking, and also having built funds. And then we have a French national, Arnaud, who has spent his entire career within supply chain and built a fund, which in many ways are quite similar to what we built at Maersk, but he built that for Kühne & Nagel and Temasek, a fund called ReefNut, which was also focused on supply chain and sustainability. So all of that to say, sort of we're this team that's come together, really sort of going after this opportunity, which, we believe is quite unique and quite exciting. And essentially sort of this is what we've all sort of been training our entire lives for. We also have a larger group of venture partners working with us on a fractional basis, who each sort of have very, very deep industry expertise. That's the genesis, and that's sort of where we all came from. And I'm, for one, I'm certainly very excited about this, opportunity to work with Christy and the rest of the team on this opportunity.
To the attentive listener, they might notice that Maersk is being mentioned here, and we're of course doing our EU CVC podcast together with Jeppe Høyer, who's a former partner or colleague of yours, Sune. Maybe to just double click a little bit on the learnings from that journey with Maersk. Of course, Jeppe has given his perspectives on the podcast a couple of times, but I'd love to just, because I do think it's incredibly important that we in Europe get better to collaborate between CVCs and VCs. So maybe you can talk a little bit about the core learnings from that.
No, I'll be very happy to. And obviously, I mean, there's sort of, having built sort of Maersk Growth from the ground up is one thing, but Christy and I and the rest of the team, we of course on a daily basis we engaged with a lot of corporates, a lot of strategic investors, and sometimes that's a corporate venture arm, sometimes it's more like their corporate development or strategy arms. And then, of course, I mean, I also, for therapeutical purposes, also actually wrote a teaching case that I'm teaching a couple of times a year at IMD in Switzerland, where I engage sort of with corporate executives around that whole piece around corporate VC. I think corporate VC is, I guess, a little bit of a complicated animal, right? But I think actually just earlier this morning, Noah and I were with a call with a large logistics firm that are sort of looking at breaking into this. And I think kind of to me it starts with this whole thing about saying, why are you actually doing this? And I actually think a lot of corporates tend to forget to ask that question. They kind of just go out and say, hey, we need to do something with startups, so we need to do we need to develop a CVC or whatever it is sort of they decide. But they haven't really sort of asked that question, why are we doing it and what is it we really want to achieve?
Yeah, actually, to comment on that, Sune, we had Nicholas on the podcast, Nicholas Savage from TDK the other day, and he said exactly that. He said probably a corporate should spend 50% of their ideation time on figuring out how to build a CVC on the why.
Yes.
Because that's where everyone gets it wrong, or not everyone, but all the ones that fail, that's where they get it wrong.
And I think sort of that was one of the things that I think we got very right at Maersk, and we spent quite a lot of time thinking about as well. Then of course sometimes as strategies change, as people change, the answer to that question also changes, right? And then of course the question is to then adapt your structure to that, right? And I think sort of that brings me to the next one. I think that whole piece about structure. I think some of the things you also got very right at Maersk was then saying, well, how do we actually structure this? And I think sort of one of the things I'm very grateful for still is that we were allowed, and I was sort of allowed within my business unit, that independence of running that fund, because the fact is that decision making and, it's very, very difficult to run a discounted cash flow model on, a $5 million startup investment, pre-revenue or a very sort of early stage. That also means if you go to a normal IC process, and you're comparing investing in startup X, to investing in 10,000 new containers or 3 new vessels, that conversation becomes very, very difficult. So I think that really is the other one, sort of that whole structural piece and the decision-making piece, right? Where we were allowed a lot of leeway and a lot of freedom to sort of make those investments. And then of course, there's a whole ton of stuff around, talent, incentives, how do you play sort of with the core business? How insurgent do you want to be, or are you kind of looking for what the core business tells you that you should be looking for? Are you looking to disrupt the core business and so on? And there's of course a ton of different elements for that. And I, as mentioned, I spent like a whole day at IMD Business School talking about that. So I can talk about that for a very long time. But I think what we're really seeing today in a lot of the strategic investors, well, both some of the people who are backing us, which includes some very, very, very large corporates, but also some of the people we are currently in process with, right? I think sort of the smart ones kind of understand, well, first of all, they understand the why. What is it they want to achieve? What are the business objectives? Then they also understand what are they good at? Per definition, I don't think, nobody's good at everything, right? And I think there's really something about sort of that understanding your own limitations and then sort of saying, okay, the stuff that we're then not good at, but we still consider business critical, who do we then partner with, right? And that's, for instance, that's where we come into the picture, with, say, one of the world's largest FMCG companies, right? They understand that they're good at this, and this. These things here, that's important for the transformation of the business because they have a very large supply chain element to their business. But that's where they partner with us and invest in us to get those strategic returns and those insights and kind of look around the corner. And then, of course, you have 1,000 different outcomes, right? You need to be true to your DNA, your corporate culture, your heritage, and all of these things, right?
Makes a ton of sense, everything you say. And we should do the IMD course one day. I want to ask you, Christy, your background investing in the North Americas and then out of London for a long time. Where do you see sustainability and the whole mobility supply chain agenda moving in the US versus here in Europe? Is it the same? And maybe this is a good pivot into talking about the opportunity for Europe specifically when it comes to supply chain and sustainability.
Yeah, well, in terms of, I guess, supply chain more broadly, before getting into kind of the sustainability topics specifically, supply chain tech is underfunded in Europe, even though Europe is really the home of a lot of large supply chain companies. So over 50% of large supply chain companies are actually headquartered in Europe, but Europe's underfunded on a VC perspective in supply chain by a factor of over 2x. So we really do need to foster the European ecosystem for supply chain innovation. And that's why we really saw this gap in the market to launch 9 Realms. That was one of our main incentives to really launch a vertically focused investor to foster this ecosystem in Europe. So we're really excited about that gap and kind of creating this specialist investor within Europe. In terms of sustainability specifically, that's a huge part of our strategy. And there's tailwinds globally for sustainability and supply chain. Over up to 90% of a consumer goods footprint is actually sitting in the supply chain. So when everyone's looking, all these corporates are looking at their agenda to reduce their emissions, they need to be doubling down on their supply chain. So this is a global trend, but obviously with differences in Europe and the US, and the outlook for the next 4 years in the US is obviously different to how it could have been. So corporate agendas may shift in the US, but we still think that corporates are going to be focused on their ESG and reducing their emissions and sustainability in the supply chain. So a lot of opportunity there. We think a lot of this technology could come out of Europe, since Europe is a little bit more advanced in some respects on the sustainability agenda. And one of the reasons we like to have this transatlantic approach is that we can actually export technology from Europe to the US as the agendas kind of come together a little bit. Also, vice versa, we could be exporting technology from the US to Europe. So that's why we like to take a global view.
Maybe you could explain a little more closely the investment strategy. How much goes to the US? How much to Europe? Primarily Series A stage you start. What does that mean in terms of then the allocation strategy with reserves and so on? How are you thinking about all this? And is there anything in the supply chain space that's different from the standard VC model, so to say?
Yes. So in terms of kind of our fund parameters broadly, as you mentioned, we're Series A focused, transatlantic, but European overweight. So about 70% of capital will be deployed in Europe. But we all have quite a bit of experience investing in the North American market and networks there as well. And different technologies evolve at different rates in both markets. So it's really important for us to kind of have our eyes on each market. But European overweight, mostly boots on the ground in Europe. So as Sune mentioned, the majority of our team is European-based with one individual in California. So that's how we're thinking about our allocation. In terms of reserves was your other question. So we're a very active investor. We think that's really important in supply chain complex industry being vertically focused. So we will be reserving about 40% of the fund for follow-on. We'll be taking leading roles within our investments and then taking board seats and really supporting our startups. So staying close and following on into the B rounds and the C rounds.
I think one of the things that's a bit special about us from a portfolio perspective, and not sort of to get sort of, into too great the level of detail of that. But I think, sort of your, often in VC, right, we talk about home runs or grand slams and whatever, right? And you have a portfolio size of X and what you're really looking for, sort of that one fund return on the portfolio, and then the rest of it doesn't really matter. I think what we really see in our space over the last couple of years is that you've had sort of a number of generalists, either generalist funds, crossover funds, and this is sort of particular in the US, but we also seen in Europe kind of moving a little bit down market, sort of encroaching a bit on our space, sort of applying that sort of normal fund logic to supply chain. We fundamentally don't believe that there's going to be a lot, if any, of these 100,000 X's in the space that we are investing in, right? So, this whole sort of B2B industrial sort of, which we are subset of, if you will, we don't believe in these 100,000 X's. There might be one or two. We'll be very happy to do those. Don't get us wrong. But really what we're seeing is that we do, however, believe that there's going to be a lot of these like 10, 20, 30X outcomes. And that's, of course, really where our specialization differentiates us, right? That I think historically, we've been incredibly good at identifying the emerging categories. Within those categories, then identifying the winners and then coming back, Christy mentioned we're a very active investor. We really think sort of in terms of value creation. So kind of think like growth equity, private equity model, we moved into venture. And then we're really good at helping these companies then grow and achieve their targets, right? And when we sort of look at the exit landscape, because that's of course another thing. One thing is that you're keeping stuff at, whatever valuation on your books, but there is also a day of reckoning where you actually need to have a liquidity event around these companies. So our main avenue of liquidity, actually, our main exit path for these companies is really trade sales, right? We are seeing all the incumbents, including in Europe, also in the US. We're seeing private equity funds, infra funds, who are very, very hungry for this space we're investing into. And there's going to be a ton of these exits in that like 300 to 500 million euro, maybe up to €1 billion. And that's essentially sort of the game we are playing. And because we are a thematic investor, because of our expertise and because of the way we leverage our strategic investors and their insights, we are very good at predicting which capabilities are needed in the future, which also means at the other end of the spectrum, our portfolio mortality is much lower than what we would see. And historically, even our losers, we can typically, recover 1.5, 2x capital on, because we've been investing in capabilities that we know that there is a demand for.
I want to stay on this point a little bit. And I want to do so because it's the age-old discussion, right? The typical VC power law model versus this model where you have more trade sales. And to be honest, it's two very fundamentally different investment approaches. Everything around how you run your firm, not just your investment strategy, changes based on which model you're going for. So maybe you can talk a little bit about how this, conscious decision to not try and pursue the 100x's, trickles down through your firm, not just in the investment strategy, but also in how in the different moves or repetitions that you do as a firm.
And I'll kick that off. And Christy, as always, you just pile on if there's something important that I'm missing. I guess sort of essentially, right? And if this sort of becomes a little bit sort of long-winded, just let me know, right? But of course,
never got too long-winded.
But I mean, it of course well, you haven't seen. No, I think it kind of starts right when you're building a firm or when you're building a product, right? I think it really sort of comes down to saying, okay, what is your USP, right? What's your positioning and what's your right to win or your unfair advantage, right? And we do fundamentally believe that there is a significant opportunity where we are positioned within supply chain, sort of late venture, early growth for a European fund, right? Which is also one of the reasons that, Christy is, come over from Canada and, we got, people with, dual passports, returning to Europe and Arnaud has been back from Singapore and I've decided to stay in Europe to really go after this opportunity, right? And I think that to me, and this is not sort of to bash anybody, but I think sort of the days of sort of the generalist funds and sort of those spray and pray models, I think they're over. And I think sort of we've seen this in the US for a while, right? Where it's pretty clear that when we go out and talk about operator-led funds with US LPs, this is just much, much, much better understood, much better appreciated. And I think also sort of when you look at how essentially VC started in the US, that's how it began, right? That some of these successful firms were essentially built by operators, and kind of we sort of carved out this niche, and we believe that this is very relevant. It's very relevant to Europe and sort of just sort of the global VC landscape, right? Now, and then of course you then start looking at, well, what does success actually look like in this space? And I think sort of if you just go out with your generalist lens and try to apply that to sort of a specialist field, I think you're going to lose. And that's also why a lot of these generalist funds have been burned pretty badly in our space. And I think they all sort of have their wall of shame and all have their stories and because they kind of applied this logic. And you kind of need to understand, what does it take to drive successful businesses in this industry? And also, what's are then realistic exit scenarios and all of these things? And I think we've taken a lot of time from our different starting points to really sort of understand that and come together. Now, some of the things that this then translates into is that, first of all, we have quite a concentrated portfolio. right? So as Christy mentioned, we're going to be investing in 15 companies. We're going to do that over a 4 to 5 year active investment period. So every year we're going to do 3, 4, 5 at the most investments. To get to those 15 investments, we see somewhere between 60 and 100 companies a month, right? So we essentially see 5,000 to 6,000 companies to get to 15. And we are, some people, and maybe that still exists, but some people, at least sort of when you tell them that you do venture, they kind of think it's like snappy fingers and you kind of flip a coin and it's all cool and so on. I'm not going to say we're not cool. We obviously are, but we're also very, very analytical, right? So we have a lot of analytical rigor in what we do, right? And we are all coming sort of from different, again, and Marie has trained as a lawyer in a legal counsel with Goldman Sachs, right? Christy described, she's been doing transaction services with KPMG. Frederick has been doing investment banking. I've been the CEO of a number of companies, right? So we're coming with a very, very different training where sort of rigor and discipline, you of course still need conviction, but we need really, really strong conviction in those companies. And then also the fact that we can actually help them, right? We are probably more science and less art than your average venture fund. You, of course, sort of still need to be able to sort of see the vision and buy into that. But I think those to me are some of the things. This also really means that from a team perspective, right, we don't really sort of believe in this sort of larger than life or God on earth franchise model, right, where you have one person and it's typically a guy who says, oh, I'm the best at everything because I built whatever company, 30 years ago. So what we really focused on is to say, okay, this is what we call venture as a team sport. Say, we need to collectively peak across every single stage of the venture cycle, but we don't individually need to peak at everything. This also means that when we have a deal, we all come together. We work on it together, right? So there's no such thing as Christy's deals or Sune's deals or no deals or Marie's deal. It's our deal, right? It doesn't matter who posts on LinkedIn or whose name is on PitchBook or whatever. Completely irrelevant, right? So it's our deal, and we all sort of then really, really lean into that. And I think there's a pretty significant difference around that as well.
The two different models, that kind of power law model and more concentrated model, us being a little bit more concentrated, it goes through our entire team culture. As I was describing the team composition, bringing in the really complementary skill sets, and then leveraging each other's strengths. I think that's really, really core to the model and the platform that we're trying to build for the long term. And then also time allocation, how much time we will spend on value creation, portfolio management, and also with our corporate partners. I think that's all really important for the way we're trying to build this portfolio.
Tell me a bit about the motivations of your corporate partners, how you leverage them as a firm as well. I think that's something that as Europe moves closer and closer to deep tech and the space of the old incumbent, so to say, where you're also looking at more trade sales typically, it only becomes more important that we, even on the LP level, work very closely with our Mittelstand companies or whatever we want to call them.
Yeah, so the way we're thinking about that, we refer to it as our two-sided value creation model. So we're kind of sitting in between these large corporates and these startups. And on the corporate side, we work really closely with these companies, really embed ourselves into their operations to learn how are their supply chains operating today, how are their transportation divisions operating, and what are their strategic priorities and what are their pain points. So we spend a lot of time to really understand this so that we kind of can predict the future trends and needs of these businesses either tomorrow or in 5 to 10 years. So that's kind of what we're doing from a corporate standpoint. And these companies can span many different industries, but industries that touch the supply chain. So for example, we could be working with a large warehousing company or an FMCG company or a retailer, transportation company. So anything that's touching the supply chain, but touching it in different ways. So we're understanding those business needs, which helps us with our theme development. So then when we're going out to the market and sourcing, we understand what are these companies looking for, and we can really kind of refine our sourcing in that way. And then on the startup side, we're helping them because we can give them access to the corporates and also kind of market research and understanding of partnership potential for the startups. So that's kind of the two-sided. But then on top of that, working with corporates from different areas of supply chain, as I described, enables these corporates to actually collaborate and work together as well. So that's kind of another benefit of the supply chain platform that we're building, is that you can have a powerhouse in these different areas, retail, warehousing, they can also work together. And so that can bring even greater insights.
I just wanted to add to that. I think sort of one of my learnings actually about sort of these, strategic investors and I certainly do the same, right? And I think there's sort of a tendency that sort of we create strategic investors to corporate investors. And I think sort of also when we started building Nine Realms, that's kind of how we are thinking about it. But I think one of the things we've seen, and maybe also with some of the political tensions that's sort of been emerging over the last couple of years, is that, we are, for instance, we're backed by the European Investment Fund, right? So they, committed 50 million euro to our fund. But we're also speaking with other either quasi or pure sovereign wealth funds, right? And they're actually also strategic, some of them more than others, right? But saying, they want to develop something, a certain capability. In our case, it's typically because they either want to do something about supply chain or they want to do something about sustainability. So how do they want to lift that ecosystem? How do they want to create, and we're having quite a few live conversations like that at the moment, which are also super interesting, right?
Is that because let's imagine this was the Danish Growth Fund, the IFO. They obviously are doing both LP investments and direct. And the reason they would then, go in with a more strategic lens would be that they're saying, okay, our LP team, our fund of fund team does the investment and make sure that it's a good investment, but we have the overarching goal in Denmark to strengthen the resiliency of our supply chains and so on and so forth. And then you don't then connect IFO, so to say, or the Danish sovereign state and their arms into the Danish ecosystem, so to say, but rather you work with the direct investment arm of IFO as well to then help them improve their understanding of what's moving and so on.
Yeah, I think sort of, more or less, but I think, and I think this is, we are right now actually having sort of 3 of those very live conversations, completely different parts of the world. But where I think essentially those 3 conversations are all sort of hinged on a couple of items, essentially sort of that basic thing saying, okay, supply chain and sustainability, that coupling is important for our country's roadmap. This is a strategic priority for us either because we already have an existing industry that needs to, somehow, go through a transformation, or we see this as an opportunity for our economic development plan towards 2030, 2050, stuff like that. We then have, managed to position ourselves so that we have kind of become the go-to when it comes to venture capital for supply chain. We've become the go-to, we kind of become the gold standard, right? So if you're sitting as an infra fund, a PE fund, a corporate, you call us, saying, hey, we would like to discuss this particular thing with you. And if you're starting a startup, you'll call us as sort of your first port of call. What we are really able sort of to sort of put together is saying, okay, we step into your particular ecosystem. We are going to mentor, we're going to work with you, we're going to work with some of, it might be your universities, you might have existing programs already, accelerator programs, government programs, and so on. And with our presence in market, this means that what we historically have seen is that other people will follow. So you'll have other venture funds, generalist funds, you have growth equity, you'll have infra, you have PE funds who kind of follow us because, hey, we are now making stuff happen in this market, and let's say more smart money will follow, right? And I think sort of that's, I think one of, you mentioned Denmark as an example, but I think Denmark is not alone. I think sort of one of the issues we have a lot of in these smaller ecosystems, kind of like it becomes quite incestuous, right? That we don't really sort of break through that glass ceiling, and it sort of just ends up being the same money circulating. Whereas because we have that global positioning, we are also able to bring in outside expertise, outside capital, even our corporate partners that Christy mentioned, right? We can also bring them in and create commercial opportunities.
I think you're absolutely right there. I think that is one of the most important things that we need to figure out how to do differently in Europe, which is we have so many different clusters in different countries. Like, I don't know how many European centers of excellence we have that claim to be the robotics hub of Europe or whatever, or robots valley or whatever we want to call it. And it's like, yes, it might be a standout achievement what we have seen in a local context, but bring a global firm and you'll very quickly realize that it's maybe not as magical as we think. And I'm not pointing here, so I just mentioned robotics because I'm very close with the robotics sector in Denmark. It's just by way of example, but I think that this is one of the core things and one of the places where I think VCs bring a very special value add compared to anyone else, which is that global perspective and ability to really cut through the noise and say, we look at 600 companies per year in this sector, and the 10 companies that you have here are all cool and great, but
they're not world class.
Maybe don't throw all your eggs in that basket. Christy, you spoke before about how you're working with your LPs to also figure out what's happening in the future. I thought that was a beautiful pivot point to then go into talking a bit about the industry trends and themes that you're eyeing here in 2025.
Yeah, so we are thematic investors, and that's one of kind of our touch points, how we develop our themes is with these corporate partners, but also just kind of using our industry experience combined with what's going on in the macro landscape, as well as just really keeping close to company formation at the earlier stage. So those are a few different ways we develop our themes. In terms of what we're looking at the moment, as we all know, there's increased trade uncertainty at the moment and regulatory and complexity. So we're looking at technologies that can kind of address this, streamline the processes for global trade. Some things like AI-powered tools for trade compliance automation or for network design is some of the things that we're looking at there. Another area that we're looking at is solutions that are optimizing resources and assets for logistics within cities. So consumer demand continues to increase, but the cost of these deliveries and also the carbon footprint of these deliveries is also too high. So things like out-of-home delivery intelligence within cities or more dynamic last mile solutions. Lastly, an area that we're also looking at is solutions to augment workforces and really bridging that gap between labor shortages, ongoing labor shortages, and the increased service quality expectations. Things potentially like upskilling. So jobs in logistics are getting more are changing as technology gets integrated. So potentially upskilling, recruitment, and retention, or technology to really kind of automate some of these functions and make the work more rewarding.
Why am I not seeing leveraging AI and the new user interface that LLMs are giving robotics solutions across the supply chain?
AI for us is not a theme, it's an enabling technology. So AI really underpins all of the different things that we're looking at. In terms of automation, that's certainly an important area for us. Robotics specifically, we are not hardware or deep tech investors. So we would not be investing specifically in a robotic solution, but we more focus on the software elements that might also have a hardware component.
Yeah, and I think if I can add to that, I think sort of on that on the whole AI piece, I think about a year ago, maybe it's a little bit more, probably a year and a half ago, we actually sort of mostly for our internal use sat down and because obviously that question started coming up, so how do you think about AI? How do you think about AI? And I think, what we're really seeing, I mean, even some of the stuff that, we in from our different backgrounds invested in, 6-7 years ago, had AI baked into it. And of course, okay, are the models becoming larger and is the power of compute going up? Absolutely. And of course, it's becoming more and more impressive. But I think sort of applied AI from a supply chain perspective is not new. A lot of the companies who've actually backed, whether it's been around autonomy or whether it's been around things like route optimization and so on, or, even things like inventory of fresh produce had actually had some pretty advanced AI models baked in already. I think what we're really seeing, right now, of course, is that suddenly you have things that maybe were not possible or economic 5 or 6 years ago, that suddenly becomes possible to solve in an economic way today. And of course, also how sort of it becomes much more accessible, of course, right? But we actually sat down a year and a half ago and kind of like made this memo mostly for our own internal use, sort of looking at sort of the different technologies within AI and saying, where did we actually think that they would play a role, right? When is GP, when are generators, becoming, relevant, when are LLMs becoming relevant and so on. And sort of broke that down, gave some different companies. And I actually think one of the things that surprised us a little bit is that I would say from some investors that I think people would consider very, very sophisticated, and some consulting firms that people would consider very, very sophisticated, right? Then, we started sort of sharing this memo a bit when somebody called, oh, we are meeting with a client tomorrow, or do you have something on AI? And we said, yeah, we've written this memo. You're welcome to share it as long as you just remember where you got it from. And that actually started traveling quite a lot, right? That these sort of like our own little scribbles suddenly really, really caught a lot of people's interest, how we were just thinking about this. And so it's obviously something we're looking a lot at. And as Christy is saying, but more as an enabler. And I think maybe the last thing I'll just say about that also, we are not willing to pay ridiculous AI premiums, so going out and suddenly paying 10x, what we think a company should be, be worth, that doesn't have any proprietary AI, but essentially just has a ChatGPT wrapper. That's not for us.
Yeah, and that of course flows naturally back to your starting point where you said that, well, we're not building a power law portfolio as such, and then the entry price is all the more important, of course. One final question before we close, I just want to ask you, because you mentioned tariffs there, and I wonder, sometimes we see things crop up in people's theses that are very current right now, but might not be that long lasting. And we have in venture, we have a 10, 15 year timeline to the final realization of the potential of the startup. So having a thesis today around tariffs might be super exciting, but tariffs might just be a 4-year thing. 2 questions in that. One, do you see tariffs, the ability to navigate tariffs as a longer term thing, and that there are other things pointing towards that than just the Trump messaging? And secondly, how do you think about this hype cycle of different topics within venture?
On the first point, towards kind of tariffs being part of a potential investment thesis, tariffs is one example of kind of very large shifts we're seeing in global trade relations. So we wouldn't pin a thesis on that specifically. It's just an example of what we're seeing. So there's been a lot of volatility in global supply chains. That's one thing that's happened. We've also seen everything since kind of COVID, the geopolitical tensions lead to kind of dual source from different markets. So it's more about focusing on how we make our supply chains resilient and flexible in the light of the fact that in the past decade, they've become nonlinear and they need to be able to be more adaptable. So that's kind of how we're thinking about that, so that we wouldn't pin something over, we would never want to be tied to a regulatory policy that could be reversed or changed in a number of years.
Because now we've talked about resilience, and resilience is really one of the very, very big headlines everywhere, and we really realized it with COVID how unresilient everything was. I'd love to ask you, this resilience agenda, I guess it's one that's incredibly important and underpinning for everything, almost everything you do.
Coming back to sort of that Maersk Growth journey, right? Back then, I didn't know it was called supply chain resilience, but that was essentially that was the headline I raised Maersk Growth Fund 1 under. Was this saying, as Christy is describing, the world is not going to continue to being linear, right? And if we sort of look back, pretty much everybody, including everybody on this call who've been born after World War II, right? We've been used to sort of this quite flat world. Same thing as applied to supply chain. And this has meant that as a supply chain manager, you have been allowed to, or you've been able to optimize your supply chain on one parameter, namely cost, right? So we started moving stuff to China. When then, coastal China became too expensive, we moved inland China. Then people started talking about China +1. Then we looked at Vietnam, Cambodia, Laos, Myanmar, Thailand, whatever, what have you, right? And I think sort of what you mentioned COVID, right? But then, then you suddenly got, a vessel blocking the Suez Canal. Then you got, the war in the Ukraine. Then you got, the situation with the Houthis, which means suddenly we have to sort of, go south of Africa. Then the U.S. West Coast, the longshoremen, they go on strike, blocking the ports. You got trade wars, all of these things. So I think the point really is that as Christy is saying, is we're not sort of, let's say, trying to pinpoint the next black swan event, but really what we're doing is we're trying to invest into companies that helps prepare or help sort of, create that readiness so you can replan and you can act around your supply chains, right? And, what are we planning for, or what are we, optimizing for this week, this month, this year, right? Maybe it's cost this year. Maybe it's sustainability. Maybe it's lead time. Maybe it's, inventory levels, whatever it might be, right? And I think sort of just a lot of supply chain managers, a lot of companies, the moment they started sort of looking at supply chain just as a cost center, I think it sort of meant that they became a little bit lazy, probably as well, or at least they kind of forgot to think about what if. And of course, now they've been paying an arm and a leg the last couple of years for freight rates, and because of this, and now I think the smart companies and a lot of those are reaching out to us actively, right, are really sort of, they're beginning to sort of say, let's figure out how can we actually, rather than thinking about supply chain just as a cost, how can we actually think about this as a competitive parameter? And those are really the conversations we are having today with, the largest FMCG brands in the world, largest, fast fashion, largest mobility companies, and so on. And we're really sort of seeing a huge common denominator around that.
I can only imagine that now is a good time to raise this type of fund. Sune and Christy, thank you so much for joining me on the podcast.
Thanks a lot for having us, Andreas.
Thanks so much.
Here's a few words from our beloved sponsor. Join over 500 LPs and GPs at 0100 Europe in Amsterdam from April the 2nd to the 4th.
You better be there too.
Connect with top-tier investors and industry leaders at 0100 Europe Amsterdam. Engage in exclusive conversations with decision makers from Bicycle Capital, Global Ventures, Dawn Capital, and many more. There you'll find over 80% of attendees are LPs and GPs, and you'll also find exclusive side events. 0100 conferences. Register now and use the code 15EUVC for a discount.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.